Hi, my friend, Caleb Johnson here, and I have a huge question to ask you real estate investors. How would you rate your level of personal discipline on a scale of 1 to 10? If your answer is anything less than a 10, I've got something neat for you. And let me tell you, discipline means pushing yourself beyond your comfort zone and doing things that are difficult and sometimes boring. Achieving massive success requires you to do those difficult things. Building your levels of personal discipline is not easy, but it does pay off. In fact, you can't achieve anything significant without discipline. Now, I just released a program for investors where I walk with you as an accountability coach to aid you stay on track so you can push yourself to do the hard things that greatness is going to require of you. Starting is easy. Go to redccapitalgroup.com and click accountability coaching at the top right of the screen. So let's get to work, and now to the interview. Welcome back, everyone. This is Caleb Johnson, host of From Trial to Triumph. Today we are blessed with a very experienced operator in real estate. So, Gino Barbaro, welcome to the show.
Caleb, thanks for having me on. How are you doing today?
Doing very well. Thanks for asking. Well, Gino, can you go ahead and give our listeners just a quick background story about yourself?
Sure. I'd like to start with when I met Jake and how Jake and I partnered up and how I actually got into the multifamily business. And I think it's important for the listeners, when I tell the story, really the story is about the problems that you encounter, but ultimately the opportunities that come out of those problems. And I had met Jake in 2009. I owned a restaurant in New York. At the time, I had 4 kids, and I was looking to scale. I was looking to do something different. That one stream of revenue, it was the Great Recession. Jake was a pharmaceutical rep. He was using my restaurant to go get deliveries of food to doctors' offices so he could sell his legal drugs. Ironically enough, he was selling vaccines back then. And in 2011, on August 10th, I remember being in the kitchen, and it was a hot summer day, and I heard this noise. I'm working, and I hear this poof sound, and I run to the cooking line, and I see that the grill's on fire. And I say to myself, oh, what do I do now? So I told one of the guys on the cooking line to throw milk on the grill to extinguish the fire. It extinguished the fire, but the fire traveled up into the hood. Now, I don't know why the hood didn't go off, why the suppression didn't go off. It traveled all the way up to the outside of the hood. So what I did is I ran outside, I put my ladder on the building, ran up, and I see these flames shooting out. And as I'm seeing that, I have these things going on in my mind. I'm saying to myself, this is my father's legacy, because I had started the restaurant with him in 1994. He passed away in 2007. So I'm sitting there going, my life's going up in flames. The second thing is, what am I going to do? How am I going to keep my employees? If this place burns down, where's my next paycheck going to come from? And the third thing is, I got to go down and get a hose. So I went and got a garden hose, and I started shooting water onto the fire. And it's a grease fire, but just try to tamper the flames. And as that's happening, I'm getting soot on myself. The fire department finally comes, and they're like, you got to get off this roof. And I'm like, I am not getting off this fucking roof until you get back here and you get somebody. And I told them what to do. 2 minutes later, they come. They do the opposite of what I told them to do. They dump water in the driveway. They have to go down the street, hook up to the fire hydrant, come back in. I finally get down. They extinguish the fire. And as they go inside, they start poking holes in the ceiling. Now, this is a volunteer fire department. They did a good job, but you could see that they're having fun. And as they're having fun, they're poking holes into my ceiling. It's like jabbing me through the heart. And I continue to say to myself, what am I going to do? I'm basically done for the next, I don't know how long. I go outside in the parking lot. I see a lot of friends, family members, insurance adjusters are already coming along, giving me their business cards. I have one of my friends from church, one of my priest friends, Father Williams, actually say to me, with a straight face, where am I going to get my broccoli rabe now? And I wanted to punch him. I really wanted to sit there and punch him. I know he was joking. I know God sent him there that day for a reason. And as I ponder back on the day, August 10th was the feast of St. Lawrence, who's the patron saint of cooks. And if you think about the irony in that, I mean, I've been in the food business for 20 years. How could I have a fire on St. Lawrence's feast day of all days? And I'm sitting there, and I'm getting all this, and literally for the next 3 months, I was closed. Now, that was the problem. All these different problems, all these different fears. And I don't think we're afraid of the fear of change. I think what we're all afraid of, anyone listening to this is the fear of not being prepared for the change. So I had a lot of things that I'd never experienced before. Are they going to pay for my employees? Am I going to get some type of business interruption? I have 3 apartments upstairs. Are they going to pay for the apartments to get leased up and fixed up? Am I going to be able to keep my employees? How long is this going to take? So after 9 weeks, I got a check for over $300,000. They paid everything. I stayed home. I had a great vacation, great 9 weeks off with the family. I got back to work, and that just lit a fire under my ass. And I said to myself, I cannot be beholden to one stream of revenue. I said, Jake, we need to do something. And that was in October of 2010. We started getting serious. Jake moves down to Knoxville in 2011, and 18 months later, we buy our first deal. It didn't happen overnight. And I ponder that, and I want everyone to be listening to this. The reason why I want to share this story, I may have gone a little too long for you, is we are at that precipice right now for a lot of people. We're going into a recession. I mean, rates have gone up. That's just the reality. It's going to happen. And a recession is usually preceded by a financial crisis, and we're in the midst of that. A lot of banks are failing. A lot of banks have done a lot of stupid things, and this is happening. It's going to change, and that may be a problem for a lot of us, but we have to internalize it. How do we make that into an opportunity? Maybe it's getting into real estate and start investing. Maybe it's start working on personal development. Maybe it's start looking back at all the relationships you have and start working on those relationships, whatever that may be. For me, back in 2010, sitting in the parking lot, I remember saying to myself, I can't be beholden to this one stream of revenue. This is risky. Everyone says, hey, having a small business, having a W-2 job is not risky. I thought the opposite. I need to scale up. I need to find other streams of revenue. I need to build and create wealth outside of this one venue. And I thank God for that day. And I got a brand new kitchen, brand new restaurant, paid my employees. Still had a tough time after that until I met Jake, and we really solidified and said, hey, let's start buying deals. And like I said, it didn't happen overnight, and it may not happen overnight for a lot of you, but understanding there's a lot of problems in your life and how you internalize them, those cards that you're dealt, how you actually play that hand, really, I think decides your future. And for me to say, oh, you know what, it was just a fire and it happens and I've got a new restaurant, I can be complacent, I wouldn't be where I am today if I didn't look at that as an opportunity.
Mm-hmm. Boom, we are getting hot and heavy in this thing really quick, Gino. And, I followed your story for about 5 years, and I've been investing for about 6. And I've never heard that story before. So that is amazing. And I really resonate with that because the reason I started investing was because my mom had both of her knees replaced, and she was around 60 years old, and she was still working as an occupational therapist. So she's on her feet 6 days, or 6 hours a day. And she had to take off work for 3 months and live off of her savings. But at the end of 3 months, she had to go back to work because she couldn't afford to retire when she wanted to and still live off of her savings. And so she'd come home from work after that time in tears because she was crying. And I saw, just how you saw, that I don't know what's going to happen in my future, but I want to be prepared, right? I don't want to have to be forced to do this, to go back to a job because, something unforeseen happened. So thank you for sharing that. And
Caleb, one thing I should mention, the other reason why I mentioned the story was the times are eerily similar to what's going on right now. When Jake and I started, the market cycle was in a buyer cycle where we're going to right now. There was a lot of seller financing. There were more deals. There was no capital. There was no syndications going on. And I think it's very similar to now. People were waiting for the reset. And 2008 came, everything reset, and then we're all paralyzed with fear. And it's happening right now. I know a lot of students in the community have been saying, oh, I can't wait till the market resets. 2019 is a high. 2020, 2021, last year was a high. And now people who want to get mentored are like, I can't invest now. I can't do it now because we're going through recession. Well, you've just been waiting for the last 3 years for this recession. It's upon us. Now is when you got to start buying and investing in yourself and creating those relationships, because for the next 2 years, asset prices in a lot of markets are going to, they're going to reset. They're going to readjust. Things are going to slow down. We're going to have unemployment. We're going to have higher interest rates. We're going to have a lot of seller financing, very similar to when Jake and I started. So people are always asking me, when's the right time to start? Well, Have you had a fire in your life? If you have, maybe that's the time to start. That's when I started. It doesn't matter where you are in the market cycle. You can buy real estate in any part of the cycle. You can't sell it in every part of the cycle, but you can buy it in any part of the cycle as long as you learn how to, all the different strategies, whether you're syndicating a deal, whether you're using seller financing, whether you're partnering with other people. So I just challenge everyone listening to this. Don't blame the market cycle or the timing. You need to be ready mentally, and you need to have a reason why you're doing it before you even consider starting to invest in real estate.
Mm-hmm. So let's say people, they maybe do have some experience in real estate, or maybe they're fresh, right? They're green. So how should they prepare for the upcoming opportunities?
I think the first thing that they should do is create a plan for themselves. And I think this sounds crazy because I want everyone to create a spending plan, not a budget plan. Whether you have $1 million in the bank, 10 million, or 100, how are you allocating your dollars? Jake and I call them baby money soldiers. And the reason why we call them baby money soldiers is every single dollar that you have needs to go somewhere. And I think early on, what we did with our baby money soldiers is we kept buying deals and kept repurposing the baby money soldiers into the next deal. They kept procreating. Whether it was a refinance, put the money back into the next deal, or a sale. And I think everyone has to allocate and see what money they have. Not every single dollar that you have needs to be at risk. We've been taught that, and as interest rates have been at zero for the last 5 years, what that does is that stimulates a lot of unneeded and unnecessary risk. Private equity, the cost of capital is cheap. So the first thing that everyone listening to this is assess your plan. How much money do you have? How much capital do you have? Are you properly insured for what's going on? Because not every dollar needs to be into deals. You need to have some money in reserves. Because I've been hearing cash is trash for the last 3 years. Well, I'm sure a lot of those people that said that cash is trash wish they had a little more cash right now because the opportunities are coming. I think the second thing is need to understand what your plan, what you're trying to achieve. So for Jake and myself, we have 1,700 units right now. We're not looking to buy 1,000 units this year. We're looking to buy a really good amount of cash flowing assets. Whether it's, we've closed on 100 units in January. We're going to be closing on 80 units in the next 2 months. We're looking for profit per unit. That's what we're looking for. We're not looking to scale up and syndicate deals right now because we're vertically integrated. We have a property management company. So we have to hire labor. We have to hire managers and maintenance techs. So for us to go on a buying spree and not really be beholden to what our buy right criteria is. So for those of you out there, if you don't know what a buy right criteria, it's part of buy right, manage right, and finance right. We're looking for assets that produce yield, that produce cash flow. And it's been difficult for the last couple of years to buy those assets. That's why we've only bought a couple hundred units in the last year and a half. But that's okay. We have not veered away from it. We haven't gone into self-storage, or we haven't gone into crypto, or we haven't gone into mobile home parks. We want to become and stay experts in multifamily. To answer your question, pick a niche. If you're doing single family and you like it and you're not comfortable with switching to multifamily, don't. Stay with the single family. Understand it. Create the strategy. You can use our framework in single family and continue to become an expert in that. And I think, obviously, what are your goals? Do you want to do this full time? So if you want to do this and ultimately end up doing this full time, you're going to be allocating more time, more resources. If you want to do this passively, maybe you go out there and you find a couple of operators who are doing it really well and you invest with them passively. So it's a tough question to answer, but I think it always comes back to the individual, what that individual is trying to accomplish, how much experience they have, how much capital they have, how much time they have. That's why, to me, coaching is indispensable, because sometimes you may have those answers, but nobody's asking you those questions. And how do you answer those questions if you don't know the question that you're supposed to be answering? If you're out there saying, I want to get into multifamily, well, how much time do you have to devote to it? What is it going to do for you, right? How much capital are you going to devote to it? And what's the end goal? Are you going to retire and go into multifamily full-time? Or do you want this as a side hustle where you're building? And that's how I got into it with Jake. I'm like, you know what? I can never see myself leaving the restaurant. But if I can have 100 units making 10 or 15 grand a month in cash flow, supplements my restaurant business, I'm happy as a pig in mud. But then when I saw the opportunities were no difference between 100 units and 500 units, well, let me go leave the restaurant. If I leave the restaurant and I fail with real estate, I can always go back to the restaurant. So things obviously do change, but ultimately starting with the end in mind, what you ultimately want to accomplish, and then let's reverse engineer that, and then that's how you get your starting point.
Mm-hmm. Gino, you said something that I've never heard before, and that is profit per unit. What is that?
It's funny because most people have not heard of that. And for us, we like the cash in the business. We started at a time when there was a cash on cash return. And the profit per unit basically is you have 100 units. You take the number of units divided by the profit, and you get your profit per unit. So on average, if we have $100 in profit per unit, if you have 100 units, that means you're getting $10,000 a month in cash flow. So we're focusing highly on that profit per unit. Now, if people who are syndicating deals, that profit per unit for them may be less because they have other general partners, they have other things going on, they have limited partners, they don't have as much equity as we do. That's neither good nor bad because their strategy may be, hey, I like these acquisition fees. I like getting these asset management fees. I'm building a business to raise capital, and I'm looking to get the scale to 5 and 10,000 units. That's a great model. You're not going to profit as much per unit on that deal, but you have different other aspirations, different goals. For Jake and myself, we love to manage the cash, and we love that PPU. On average, we're getting about $250 per month in profit per unit. In our East Tennessee market, it really varies from market to market. Some markets may be a higher profit per unit, but then the cost per door is going to be more. So it really varies on where you are. In markets like Cleveland, you're going to get a higher profit per door, but a lower one, but those units are a lot less expensive. So it really depends upon your market. So for us, we want to focus on that going forward. We want to manage the cash in our business. That's really important to our underwriting. What's our pro forma cash on cash going to be after 18 months after we take over this asset?
I love that. And again, I've never heard of that, so that's really good to know. Now, Gino, I want to talk about how you scaled, right? You scaled from 1,500 units in 5 years. And so break that down. How did you guys do that?
Very simple. I had one restaurant for 20 years. From 1994 that I opened to the year 2016 when I retired and I left. And I will attribute that, well, maybe two things, but one thing in particular, I had no core values, I had no mission statement, and I had no real leadership. I had no real reason why. I started that business, believe it or not, for my family and for what it was going to do for me. And you should never go into business, you should never start a venture if you're getting into it for yourself only. That's the reality. The reality is, hey, what can the restaurant do for me? And when I was hiring people and I was firing people and I was bringing on vendors, I didn't have core values. I didn't know what to aspire to. I didn't know how to hire team members. I didn't know how to fire team members. I had no culture within the restaurant, and it was very hard to scale that. I mean, you just can't. You're the mom and pop. You're the I'm a person. I'm going to do this, and I'm going to do that. And that's how I was raised. My father was an immigrant back in the 70s and 80s. That worked really well. If you had your one little pizza shop, your one little food stand, your one little barber shop, one little insurance agency, you could have made an amazing middle class living back in the 70s and 80s. Once the 2000s came, the internet changed everything. Unfortunately, inflation took over. You needed to start scaling, and I didn't do that. And then for me and Jake, it was a completely different paradigm. All of a sudden, we have a 25-unit deal. It's our first deal. We're both working full-time. Well, we have a resident manager there. We're not managing this thing ourselves day to day. That resident manager is managing it through Jake. Then we bought another deal, a 36-unit deal. And then we bought a 136-unit deal. So as we're starting to scale up, at around the 400-unit mark, we're like, how do we take control of this? We need to do something. We don't have the proper property management software. We don't have the proper systems. So we hired a scaling up coach. We actually we started working with EOS with Gino Wickman first, working on traction, and then from there we worked with Vern Harnish's group scaling up. We started learning all these different strategies. Well, there are systems, there are ways to pull yourself out of those meaningless jobs and have somebody else do them for you. And when I mean meaningless, I mean jobs that you're doing for $15 an hour, like washing dishes, where you should have somebody else doing that, and you should be working on, on the business, not just in the business. And that's what ended up happening. You start doing things and you start hiring people. Why is Jake editing videos from our podcast? Why is he doing that? Why am I doing bookkeeping? Why am I doing that? But it's the I'm a mentality. And I think as you scale as an entrepreneur, you learn how to bootstrap it. You are the person. You're doing everything yourself, but it comes to a certain level. And I think for multifamily at around the 100-unit mark, that's when it's make or break it. If you want to continue to scale, you need to hire a property manager and you need to hire a maintenance tech. And that's what multifamily allows you to do. And at that point, we had already been hiring. But then for us, what were the bigger aspirations? How do we start building a team? And, we went from one employee to now we have over 70 employees on the property management team. The Jake and Gino team has about 12 to 15 employees, plus coaches and, a lot of people who are remote and they're working full time. But I think working on your core values, working on your mission statement, working on a vivid vision, as Cameron Herod likes to say, understanding where you want to go and learning how to implement systems will really help you in any endeavor. Because at the end of the day, real estate is an entrepreneurial venture. At Jake and Gino, we create multifamily entrepreneurs. If you're buying single family homes and you're buying them, you have to think of yourself as an entrepreneur. Every single one of those little homes is its own independent business. How do you scale those up, whether you have 10 or you have 1,000? And as a business owner, the more people you can serve, the more money you're going to make. I only had a couple hundred people a day walking into my pizzeria. That's the reality. That's why I couldn't get rich. But as a multifamily operator, if you have thousands of units, guess who's going to make more money? A person who has thousands of units or someone who's only serving 50 people? Big difference that we didn't understand, that we didn't grasp. And as you start scaling up, you start implementing more systems, start building systems out, and they're not complicated. They're just going to evolve over time. And trying to get people to fill the shoes that you can't, or that are better than you, or those tasks that generate revenue. So in multifamily, the tasks that Jake really excels at, he excels at finding deals, he excels at negotiating deals, underwriting deals. That's where he needs to focus a lot of his time. And that's what we weren't doing early on to scale. But once he had people around him to help him out with other tasks, he was able to focus on those tasks. I hope that answers your question. Does that answer your question?
That did. Tons of gold in there. And one thing that I remember learning from you in the early days was the I'm a mentality. I'm going to do this, I'm going to do that, and I'm going to do this. And I think so many people, especially starting off, sometimes you do have to play that role. You do need to do a lot of the stuff, like you said, when you're first scaling. But there comes a point when you have to start hiring people and really having that scaling mentality so that you can build the systems and processes to be able to scale and not really, sometimes I can hear stories about people that they had the I'm a mentality and they get to 400 units or 500 units and their business just crumbles. Their family life crumbles because this business is running them, and then the business starts failing and suffering, and then it just goes downhill from there. So I love that 100 unit kind of mark, and I think that can be dependent on some people and their different life, and there's some nuances there, but I love there has to be a time when you really consider scaling and taking that seriously.
Caleb, I think at some point when you are out there and you're thinking to yourself, man, I really could use help with the landscaping, I really could use help with bookkeeping, you're way past hiring. And I know this, and I'm a lot slower to hire than Jake is. And I think most people out there have to realize that. And when you're saying to yourself, well, it's going to cost me $50,000 to hire a bookkeeper, let's say. Well, if you look at it this way, and what is that, $5,000 a month? So if you're hiring somebody, you're going to be hiring them on a trial basis for 3 months. So you're really allocating $15,000 to that hire over the next 3 months. If it doesn't work, you let that person go, no harm, no foul. But what would it look like if you didn't take that risk for $15,000 and bring that person on? And 8 times out of 10, if you get the right person in that job, that investment is made back in 3 months. You're like, what did I take so long to hire this person? And every time we've done that, it's like, wow, why do we take so long to get a regional? Why do we get so long to get a safety trainer? Why do we take so long to get a COO? All of these things, it's natural because it's fear, because it's change. You're changing. You're unaware of the change. You're not prepared of the change. But once you've gone through it a few times, it's just like another muscle. And I'm here to tell you, don't be afraid. If worse comes to worse, after 3 months, you let the person go and you take that responsibility back over again.
Mm-hmm. So, Gino, you talk about your 3-step framework. And so can you break that down for us and really just say what that is?
Jake was sitting outside one day at his house, probably about 10 years ago, and he's a big landscaper. He's a chainsaw guy. He calls himself a redneck. That's what he likes to do on his days off. He likes to burn stuff and he likes to cut down trees. That's what he calls himself. And he's sitting in the grass one day and he's got a wheelbarrow and it's tipped over. And he's like, 3 legs. He's like, the 2 back legs and the wheel. Well, the 2 back legs of the wheelbarrow are the buy right and the finance right. Once you buy an asset, once you finance it, those are done. They're stable. The wheel of the wheelbarrow is what's in motion, constant motion. Now, you can either manage the properties yourselves or you have third-party property management, but they have to be managed, these assets. And if you have all three of those, legs working properly, that wheelbarrow is stable, and you're going to do really well. And in each of those components, there's different, things that you need to do in each component. In the buy right, people always say, hey, you buy money, make money in real estate when you buy. Partially true. I think you make money in real estate when you exit as well, which is the big capital appreciation, whether you're selling or refinancing the deal. So, buying that asset, once it's done, it's taken care of. The financing right now, people are telling us we were crazy, not, getting the short-term debt 2-3 years ago. We're always into the longer-term fixed rate financing. That's what we want to deal with in finance right. But you also have seller financing. Seller financing is great right now, understanding that. And the manage right portion, we talk about the systems. We have our systems with our property management team. We teach the students all of those systems and the asset management systems as well. So when you're looking at it, even from I think any real estate asset, when you're looking at it, any niche, if you can use those three legs, those three types of framework and look at a deal from that perspective, I think you have a much greater chance of success with that asset.
Mm-hmm. I want to break that down a little bit whenever it comes to the finance right piece. And I think we're going to see a lot of opportunities coming online that are because people did not finance right. They got this bridge debt that had a 24-month term on it, and now they are forced to either refinance or sell. And most likely they're going to need to sell it because otherwise it's going to be a cash-in refinance. And so how do you, whenever you're looking at an offering to buy, and you're thinking about buying it right and then financing it right, at what point do you kind of walk away from a deal and think, this is just not going to work because, one, it might be too risky to finance it, you might need to get some bridge financing on it, or maybe you aren't able to buy it right, you aren't able to get that price that you want. So at what point do you really walk away and say it's just not worth it?
Caleb, I think the problem that we've had over the last couple of years is it's not so bad to be using bridge debt. People are using bridge debt to buy stabilized assets. That's where the risk comes in. When you're buying a deal that's stabilized and all of a sudden rents are $1,000, but you can go to $1,500 in rents, and you're buying that asset based on that value add, and you're buying it on bridge debt, there's a lot of risk there. Because you're buying it on a hope and a prayer, and you're trying to time the market. There's a lot of risk in that. That's how you can tell you're coming towards the top. The other one was all of a sudden the cycles of deals were going from 5 years to 3 years to 18 months to 12 months. That's the second thing. I'm trying to teach people history of what happened in this from the buyer's market to the seller's market. That's the seller's market. Those are two things that you can say, wow, the next time that happens, things are getting really frothy. So when you're looking at a deal, the biggest mistake that we made when we started out, we never thought of our exit strategy. I mean, exit strategies are important because if you don't know what your exit strategy is, you don't know what type of debt you're going to get. And that's what, I guess that'll lead me to what we call the 3 pillars of real estate. The 3 pillars of real estate, we've coined the term, we've trademarked it. It's market cycle, it's debt, and it's exit strategy. Now, they're all over the place, these terms, and we've put them all together. So when you're looking at a deal, you have to understand what part of the cycle you're in. If you know your exit strategy, if you're doing a short-term deal, then you got to go with bridge debt. Right? So that's how you know what kind of debt you're getting. For us, we're buying these assets right now. We're getting loan to cost with 5-year terms from community banks. So we're locked in for 5 years. So we have plenty of runway. So within the next 5 years, rates drop, we can refinance them out, and then we're going to go to either agency or back to the community bank for a longer term. So our typical buys right now, we want to buy these assets, buy right and sit tight. So that's the kind of assets we're looking to buy. And I think people, if they don't evaluate what their exit strategy is, they may want to flip a deal, and then all of a sudden they have this big prepayment penalty coming, or they don't have that finance right locked in for at least 3 or 4 years, and then their debt comes due. That's what happened back in 2008. A lot of people lost their deals not because of the market itself, but because of their debt. Their debt came due. The valuations dropped. They were still cash flowing, but when your assets were $3 million, and then all of a sudden the value drops to 2.4 because of the market, but you're still cash flowing, and the note gets called, and you can't refinance it because values dropped. That's what ends up happening. That's why we've been big proponents of long-term debt. Our first deal, I mean, we have over 30 different deals. Our first deal that comes due is in 2026. So we've taken interest rate risk off the table for ourselves. We've been able to do that, and we've been able to do that methodically. And our deals, they expire every couple of years, so we've spread that out. But back to your question to buy right, it's really important in the market cycle to create a buy right criteria. When we started back in 2013, C property value adds were really cheap. That's what we focused on, those older assets. We were able to buy them really well, and it was okay to put 10,000 or 15,000 unit into them. And then our strategy was to hold those long term because they're basically new. Now, in this part of the market cycle, the Bs and the Cs, they're pretty much very similar priced. So why would I buy a 1950s or 60s asset when I can buy a 1980s or 1990s that's a little bit newer? I may pay a little bit more, but if my strategy is to hold this deal for the next 10 or 15 or 20 years, it's a newer asset. There's going to be less CapEx involved, and I that's the type of vintage that I'm looking for. So for everybody out there, figure out what your buy rate criteria is. Let's go with median income of the area. Let's go with the unit mix of the area. Let's go with type of amenities. We like washer and dryers. We like brick. What's the vintage? 80s, 90s, newer. I'm just stating some of the stuff that we like. But as you're talking about this, I think every investor needs to get clear on what they're looking for. And you can do this in every niche. If you're a single family home person, you like 3-bed, 2 baths, 1,800 square feet, median income $60,000, this school district, that's the kind of stuff that you need to get dialed in. So when a property and the deal comes across your desk, that's the deal for me. And oh, by the way, you can go tell every broker out there, this is the deal that I'm looking for. And guess what? They'll come to you with those deals. Once you can get focused on something, man, things start happening. And we always say people don't lack motivation. They lack clarity. Once you get that clarity around where you are in the market cycle, what your exit strategy is, what your buy right criteria is, all of a sudden these deals start appearing. You're like, oh, wow, that's pretty cool. That mom and pop 1990s build. I got 42 beds, 23 3-beds. Median income is 62 grand. It's brick. They got washer dryer hookups, and that deal is for me. I want that deal. So, and unfortunately, the markets is always cycling, is always changing, so you're going to need to change your buy right criteria with the market. But once you understand, hey, this is what I'm looking for, you can change. Now, as the Bs and the Cs start getting that little bit more, I guess, of a, the cap rates start, going up a little bit higher for the Cs, I think, hey, getting those older assets, I'll still buy older assets. I just need to buy them for the right price, and they haven't been the right price for a long time. But I see those prices starting to come down in the C properties, and I'll guarantee everybody out there, give it another 12 months, they will come down because those assets will be harder to finance because banks are being very stingy. Oh, you got to put CapEx aside. That roof has to get taken care of. You have the money aside for that. All of a sudden, prices start coming down because they have to reflect what's going on in the debt markets.
Mm-hmm. Gino, before we head to the final 3 questions, I want to ask you to really understand what you're experiencing in your business, being someone with so much experience, what challenges are you facing in your business? Or if you had to solve one problem or maybe implement something in your business that would get you to the next point, what would that be?
Well, we have a couple of different businesses. I think we take the Jake and Gino, the education business. It's always constantly marketing for us. We're always trying to market for the right student. We're not here trying to onboard a brand new investor who has no experience, who has really no shot of taking a deal down. We're looking for people who are in the single family space looking to get into multifamily. We're looking for small business owners. We're looking for owners who are professionals, doctors, lawyers, sales executives. We have people from Salesforce coming on, people who have capital. And then we're also looking for multifamily investors, people who have the ability that own multifamily or looking to scale. So for us in the education side, it's always marketing and always trying to bring on qualified students. I think on the business side, on the investment side, for us, it's constantly trying to get the right labor. And this is what's good about this whole economy right now, where people see a problem, we're going through recession. Well, guess what? You can start hiring again. Costs are coming down, and people who you want to hire are coming back into the labor force. So we can hire property managers now. It's easier to hire maintenance techs. So for us, it's trying to continue to build that enduring organization, and we want to become the Chick-fil-A of apartments with that customer service. And there always comes challenges to that. I mean, there's always challenges to the system. You're not always delivering great units. You're not always getting the great customer service. You're always trying to get better with that. So that's the challenge on that aspect of it. And then, like I said, the challenge on the education side is just trying to get the message out that we want people who want to invest in themselves and look at this asset as a long-term investment, and it's not a get-rich-quick scheme.
Mm-hmm. Well, Gino, you have me thinking about Chick-fil-A now, so maybe if you can start building a Chick-fil-A on your apartment buildings too, that would be pretty cool. Well, hey, if we go into the final 3 questions, number 1 is going to be if you can recommend a book to our listeners, what would that be?
I'll give you 2 books that I've read in the last 2 years that really helped me out. I read Mindset by Carol Dweck. Easy book to read, a couple hundred pages. I've read it a couple times. I read it years ago, and I interviewed Eduardo Brisenis, who was the case study for Carol Dweck in that book. Mindset, phenomenal book. And the other one is, I love Stephen Covey, The 7 Habits of Highly Successful People. It has nothing to do with real estate. It has everything to do with mindset. And I read that book back in 2008, 2009. Didn't have that as big of an impact as it did when I read it 2 years ago. I'm like, I can't believe I didn't really resonate back then. I just wasn't ready for the information. But Covey's book, that book is amazing. If you go into that book thinking with the end in mind, sharpening the saw, first things first. There's so many great habits in there that if you start executing on those habits and working on yourself, there's no way that you cannot succeed.
Mm-hmm. And Gino, if people want to learn more about you, where's the best place for them to do that at?
Just go to jakeandgino.com. If they go to jakeandgino.com/webinar, they can sign up for a webinar that me and Jake do every month. We have a live webinar once a month, and we have the recorded one on that site as well. Just go take a look. I mean, every month there's something different. This month we're going to be talking about financing. Last month we talked about the pitfalls in real estate. 3 months ago we talked about the 3 pillars of real estate. 4 months ago, we talked about the buy right, manage right, finance right. So for us, it's just constantly putting information out there and education out there just to tell people that now's the time. If you want to build an enduring organization, you want to start buying deals, now is the time to get into it, because these next 2 years, there's going to be a ton of opportunities out there.
Mm-hmm. And Gino, if you can share one final thing with the listeners that they can take away from today's show, what would that be?
Patience. For us, the last couple of years, like I said, didn't buy 1,000 units, but there were other things we could do. We worked on our systems. We worked on the profitability of our company. We worked on hiring better employees. We worked on cutting costs. We worked on getting better deal flow. We worked on our relationships, and that's all paid off now. I think what happens as investors, we get the deal junkiness, and if we don't do a deal in 6 months, something's wrong, and then we have to make that mistake, and we may look at a deal and go, it doesn't really fit our deal, but we need to do it. I think if you have a 20 or 30-year career, if you don't do a deal in 6 months of that 20 or 30 years, looking back at it, was it the worst thing in the world to happen? No. So I think patience and long-termism. Once you can couple the long-termism and being 100% responsibility junkie, I think once you do that, you are on the step to having a great life and impacting others' lives as well.
Mm-hmm. Gino, thank you so much for being here. It was a real privilege to have you on the show and just glean some things from this. So I appreciate your time, and I appreciate you being here.
Thank you, Caleb. Thank you.
And to all the listeners, we'll catch you next time. Bye.
It's time to grab your victory. Find us on the web at redseacapitalgroup.com and follow us on Instagram and Facebook at Red Sea Capital Group.